everybody. Welcome to Investing Education Academy. We're trying something a little new today. So you're gonna see a different presentation from us. So if something goes horribly wrong, just bear with us. For those of you all who are listening to the podcast, you don't know it, but we're actually using a new platform to go live. So it should be fun. We have little toys and things that we're going to play around with. And if you want to see the live recording of our podcast, go to Business with Brent Simpson. And actually, you can go to our Facebook group too. Our Facebook group is Investing Education Academy. In parentheses, you're going to see IEA. So just essentially search Investing Education Academy on Facebook, and you should see the group. You'll see us live there every Wednesday at 9 p.m. Leon, did I miss anything?
Yeah, so we're also live on YouTube. We're live on Brent's page, like you said, Brent Business with Brent, on our YouTube channel, on our Facebook page, and then inside our Facebook group. So if you have any one of those, you can catch us live every Wednesday at 9 p.m. on those particular locations.
Yeah. So our topic today is how to profit from what is happening in the stock market, and also we're going to talk about what's happening. While Leon tells you why we picked that topic, I'm still going to do what I normally do, which is a little housekeeping.
Yeah. So most people like us who are in the market know that so for my account, this is speaking to me personally, for my account, it peaked exactly on September 1. And since September 1, it's been down for the month of September. I think I'm down 5 or 6%. And we've been having a discussion inside the membership platform about kind of why that is, right? And we're going to talk about the main reason why it's down, but there's another reason why the market typically is down this time of year. And so for those that don't know, the month of September is historically the worst month of the year for the stock market. The stock market on average is down about 1.5% over the last, I believe, 50 or 60 years on average in the month of September. So the month of September is typically volatile. What's going on right now isn't unusual, but the magnitude of the moves, especially we've seen in tech stocks, is kind of unusual, and we're going to talk about why that is tonight. So we're kind of addressing this issue because one, we're all kind of feeling the pain right now in September, and two, we want to kind of explain why this is kind of happening. So the first reason, like I said, number one, is that September is typically the most volatile month of any given year. It's been like that for the past 60 or 70 years. The month of September is typically down 1 to 1.5%. The real reason we've seen this really, really crazy volatility the last 2 weeks, 2 to 3 weeks, well, really since the beginning of September, is interest rates. Now, and for most people that are, I'll say this. Most people that follow IEA, follow Brent and I, most of us are in tech stocks, right? Because that's where most of the growth in stocks are going to come from over the next 30, 40 years are tech stocks. And most of us are feeling a little pain right now because tech stocks are getting hit the most right now during this pullback based on interest rates. And we're going to go into kind of why that is in a minute. But Brent, you got anything, Dad?
Yeah, you want to look at the 10-year and the 5-year treasuries. We're probably going to touch on that. So just understand there's an inverse relationship from the market sometimes between the market and the bond market. So yeah, we could dive into it. And also, if you have questions, please put your questions up. We can actually see the feeds coming from all platforms. So anybody who has a question, if you're on YouTube or if you're in one of our Facebook page, groups and you're watching us, ask the question. We'll do our best to answer it now. If we can't answer it now, we'll either answer it in our Facebook group or on our platform.
Yeah, so we're about to pull up slide 1. And we're going to run through the big elephant in the room right now, which is interest rates. And the reason that we're seeing this volatility is because up until this point, the only game in town to put your money to get any sort of return has been stocks, right? So I'm just going to kind of go a little history. So back in March of 2020, when the pandemic hit, the Federal Reserve, who essentially controls interest rates, they lowered them to effectively zero. They lowered them to 0.25, which is effectively zero. And so anything that was interest-bearing, savings accounts, checking accounts, CDs, even bonds, you had no return, right? There was really no money to be made. So anyone who was looking for return had to put their money into the stock market. It's the only place you can get a return. Couple that with during the whole pandemic, a lot of people lost their jobs. A lot of people were just sitting home, working from home. So investing actually became a form. And a lot of like new millennial traders have said this. Investing became the stock market basically became a game, right? They had money from unemployment. They had money from some people had boosted unemployment, so they had to do something with it. They put it in the stock market. Well, we all saw the market last year race up. I think it was like 80% in that year, and this year so far we're up about 18%. But again, that's in an environment where there was no alternative. Interest rates were effectively at zero. So putting your money anyplace else, you weren't getting anything. And also remember that typically the stock market returns on average 10% per year, and 12% when you count dividends. And the reason that is that typically, outside this crazy time we're right now, interest rates will be anywhere from 2 to maybe, well, I say 1.5 to 3%. It's kind of the range you'll see typically. And remember, if you're sitting on $50 million or $100 million, 2% on that is great, right? But again, that there's been no interest rate that you can really get any return on because rates have been close to zero. So what's happening right now is last week the Federal Reserve introduced this term called taper, and a lot of people may or may not have heard that. But what taper is, so just another quick history lesson, is that what's going on behind the scenes right now is that the Federal Reserve is buying I think it's like 80 or $800 billion a month in bonds. And bonds has an inverse relationship with interest rate of bonds. So as bonds rise, the interest rate falls, and as bonds sell off, the interest rates rises. And so what's been going on recently, the Federal Reserve has been buying up bonds like crazy, so it's been pushing rates down to zero. Now, what's been happening recently is that as the market's kind of got a little more topsy-turvy, big money is becoming into buy bonds as kind of a safe haven, pushing up. They've been selling bonds because rates have been rising. And what that does is, so think about it. If you had $50 million, right, and let's say a month ago rates were at 1%, and now you turn around and let's say you bought bonds back then at 1%, a return of 1%, and now you turn around and see the rate on bonds right now is 1.5%. That's a 50% increase in the return you can get in a bond in let's say a month. So what are you going to do? You're going to sell your current bond at 1%, and then you're going to buy the bond at 1.5% and get that higher return. That's what's happening. That's what's sort of happening right now, is that a lot of this big money is seeing that rates are rising, and what they're doing is they're selling. They're selling off some of their bonds, but they're also selling off a lot of their stock. Because remember, stock is very risky, and bonds are essentially guaranteed money because it's money backed by the U.S. government. So what's happening is a lot of these companies are selling their stock and then moving into bonds because they can get a higher return. The return is still relatively small compared to the stock market. But again, if you're sitting on $100 million, you'll take 1.5%, any day, all day on that, from that type of return.
Yeah. And, for you all who are thinking about stimulus and these things coming out, like we're supposed to be getting stimulus money. Also something driving the market down is the fact that people know that unemployment for some is stopping in October. So, with that, they're like, oh my gosh, those people who were playing the game with unemployment money realize, like, I need to make sure that this is absolutely available to me. And so just because of emotions, really, a lot of individuals are pulling money out of, the market and putting it into accounts that they feel like are more secure, guaranteed. But then also with that, as the government prepares for this next stimulus round, the government is more inclined to sell bonds. As the government becomes more inclined to sell bonds, because in case you didn't know, that's where we get the stimulus money from, is one of the places, primary places. As they sell more bonds, they can then afford to pay out stimulus. However, this is a very, very complicated relationship, because that means what Leon just said, that more than likely the bonds that they bring out have to be more attractive in some form or fashion. So either they're going to make the bond cheaper to purchase, meaning if it was $1,000 bond, they're going to make the price for it maybe $900. So what that means is the effective rate of like 1.5, which I think it spiked at one point to like 1.6. The discussion was that a 10-year treasury would hit 1.6, which if any of you all don't know, the tipping point for bonds to affect the market are about 1.5, 1.4, 1.475, like in that space. And that's for the 10-year. For the 5 years, like 0.57 or 0.75, somewhere in that area. If either of those happens, normally you see the market tend to panic and just pull out. People start to pull out because, well, again, it's considered safe money because it's backed by the full faith of the government to be able to pay it. In this environment, both of those happen at once. And that's something that rarely ever happens. You're talking about it was for the 5-year treasury, I think in September, it's been the fastest growth that it's seen in like 10 years. So considering that now the 10-year treasury hits 0.5, is like the perfect storm for people to pull out. The government has to issue new bonds because they have to pay for upcoming stimulus. So now there's going to probably discount that bond in some form or fashion to make it more attractive, which means people are going to sell their old bonds to get new bonds. And a lot of people who don't have money to buy bonds, who want to stay safe, are going to pull the money out the stock market. And the money in some ways is also being pushed because the economy seems like it's getting stronger, which again, very strange. But as that happens, people go to buy bonds because the interest rates are better, but then they're pulling the money away from the stocks. So it's quite the interesting story when you start to unpeel the layers.
Yeah, and another thing, so Brent has a slide up here. We're going to go through these 5 bullets and just kind of break down what's going on. So as we said, as rates rise, typically stocks pull back some, not a lot, some. But what we're seeing right now, and the point of making the first bullet, is the reason we're seeing the stock market, and particularly tech stocks, really take on the chin, is the rapid rate. It's a rapid rate of the increase in the rate of interest rates. So it's not necessarily that they're moving up, right? Like we're going to show you in a minute. The stock market and rates generally move at the same. They're basically correlated. As rates rise, so does the stock market. It's when we get these rapid spikes in the market, in the interest rate market and the bond market, where rates rise quickly, that the stock market panics and sells off. So and we'll show you we'll give you a visual of that in a minute. So bullet 2 is saying what's happened over the last, the rate of change? Oh yeah, over the last 2 weeks, which is crazy. So people that follow bonds, probably not a lot of people like Brent and I do, but bonds are up 15%. The interest rate on bonds up 15% in 2 weeks, right? The third bullet point shows how in the prior 2 months, from July through September, the interest rate on bonds went up 18%. In 2 months, it went up 18%. In the last 2 weeks alone, it's gone up effectively the same amount at 15%. So that shows the seriousness of the spike that's happened to bonds in the last 2 weeks, and we've seen the market sell off like crazy over that roughly that same 2 week period.
Yeah, and Leon, real quick, one point I think all the listeners should know is that there's a direct relationship between the 10-year treasury and mortgage rates. So for those of you all who kind of don't know what this means that the mortgage rates for mortgages is going up as well. So when you understand the relationships, and this is why we really say if you're not part of a community that's talking about money on a regular basis, you need to become part of one, because conversations like this help you understand when should I be buying a house, when shouldn't I be buying a house, what's happening in the market, what's happening in the bond market. And even when you see like a 15% or 2%, 18%, that just means that it's just getting to it's going from 0.9 or 0.1 to 0.1.5. So, just understand it's still not above 2%. So, some of y'all may be reading this the wrong way, thinking, oh, 18% up, 18%. Like this, I didn't know I could do that in bonds. And it's not what you think.
Yeah, right. Yeah, you're not going from $10 to $18. Like Brent said, this literally going from 1.0 to 1.3. But the percentage gain is the percentage gain, right? 18%, 15%, it's still the same percentage gain, right? It's a huge move. I mean, think about it. When's the last time you've been in any interest-bearing account, CD, savings account, checking account that's gone up 15% ever, right? And we've seen.
Leon, too. One thing people have to know: bonds, when it goes up, that means the next series of bonds went up, not the bond, not the bond that you're in. So it's not an 18% move for people in the bond. So let's make sure we're clear with that. Bonds are contracts where you're locked in. So although it's an 18% increase from series 0.333 to series 0.4, you have to sell out of series 0.333 to buy into series 0.4. So it is not at 18% like you're in it and it goes up 18%. The next series went up.
That's a good point. Yeah, and that comes back to the point of why big companies are selling their stock and getting into bonds. or they're selling their bonds because they're looking at it saying, well, hey, I'm in this risky asset, these tech stocks. Let me sell these and go jump on these, this relatively safe bond at now 1.5%. But Brent, if you could pull up slide 2, I just want to give a visual to everything that we're kind of talking about to show basically how interest rates and the stock market actually move pretty much in tandem. It's only when we get these spikes that we have issues. So on the screen now we have it's a line chart of the stock market and the 10-year Treasury from 2014 to 2019, roughly 2020. And at the far left, starting 2014, you see that the stock market, which is in, I believe, blue, and the Treasury market that's in red, you see how they're kind of trending down the same, right? They're one's not taking the lead on the other, they're just kind of moving in the same tandem. They bottomed about 2016. From 2016, they both started moving up together. Now, if you look at 2018, what do you see, right? You see a huge spike, the red line, in interest rates. And what happens there? You also see a huge drop in the stock market. And what you see with the red line being interest rates is that it didn't turn over, right? Once it made that spike, it continued higher. Now the move higher was a little less than that spike, but it still continued on a pretty dramatic clip going up. And you see the blue line, the stock market just sold off and crashed. So what this is showing, what I'm showing this for is showing that generally the stock market and interest rates move pretty much in tandem, but it's when we get these dramatic spikes is when the stock market loses its mind and it really starts to sell off. And that's what we're seeing right now. We had a huge spike of what 15% over the last 2 weeks in interest rates, and the market has not crashed, but it's taking a big hit. All right, Brett, if you go back to the slide 1.
Yep.
So that's want to give a visual on kind of what we're talking about. So next point is, how do you profit from this, right? So the way you profit from this is you look for stocks that benefit when interest rates are high, right? So when rates took a hit last year, all banks, brokerage firms, and insurance companies sold off, right? And the reason they sold off is because a lot of their income comes from interest rate bearing services. Banks have CDs, savings account, checking accounts. Brokerage firms, a lot of people don't know this, but when you have your money sitting in a brokerage account like TD Ameritrade or E-Trade, a lot of times what they do is they'll sweep your money into a interest bearing account where they'll earn interest off of your money and then sweep it back when you're ready to trade. So those, while those rates are low, they're not going to make as much. When those rates go high, they're going to make more money. And then finally, insurance companies, they are massive investors in bonds. They're one of the biggest bond investors on the planet, which is insurance companies.
Yeah, so I think insurance companies honestly are one of the biggest investors, period.
Right.
The people really just don't know about. Yeah.
Options, yeah. But they're also huge investors in bonds. So in this rising rate environment, those are 3 good industries if you want to make some money on these rising rates and kind of help buffer a little bit of that that tailwind we're seeing in or the headwind we're seeing in stocks because rates are rising so fast. And I will say that we saw this also back in like February, March of this year. We had the same thing. We had a huge spike in rates, and then the market took a big hit. And tech stock, and I just want to make another point. Tech stocks typically get hit harder because typically tech stocks, a lot of them don't have any earnings, right? When you buy stocks, the theory is you're buying stocks based on the earnings and the future earnings of the company. Well, if you know a company's not going to make money for 2, 3, 4 years, you can either wait on those earnings and hope the stock goes up, or you can just lock in 1.5, 1.7, 2% now on your money. Again, if you have $50 million, that's a huge return. So tech stocks take it on the chin a little harder because their earnings are typically off in the future because they take all their money and just plow it back into their company to help it grow. So that's why you're seeing a lot of the Nasdaq's been selling off a lot. My portfolio was down quite a bit because I'm heavy in tech. So that's the reason you're going to see tech stocks kind of sell off more than usual. But like I said, a way to buffer that, look for stocks, look for banking stocks, look for brokerage stocks, and look for insurance company stocks. And those should kind of buffer a little bit of those losses because they do well in rising rate environments.
Yeah, but just also too why you have a diversified portfolio. So if your portfolio includes real estate, investing, crypto, NFTs, I'm not a fan of bonds, so you're not gonna hear me say bonds or savings accounts because even though we're talking about it, it's not something I would abandon anything for and go to. And for those of you all who think, oh, well, this also doesn't mean CDs rates will go up at banks. Yes, but you're talking about something going from maybe 1% to 1.4%. So, if I would never say never. It's highly unlikely that I would ever suggest those, but we do want to inform you these things. You may see the rates going up, and to be cognizant, be a good consumer. It doesn't mean that it's a superior investment, and it doesn't mean all of a sudden you're winning. The pain of losing is just slower. So
Right.
it's not as if they fixed it and now all of a sudden bonds are super attractive. They are not. This doesn't mean the savings account all of a sudden are going to pay like 10% on any money put in the savings account. The average interest rate on a savings account in the United States of America is somewhere between roughly like 0.04 to 0.07%. Is like somewhere in that range. Yes, 0.04 to 0.07 is the range. You can Google it. And if you have your money in the bank right now, you're listening going, oh, they're talking to me. Yeah, we are. Like, don't do that.
and here's how ridiculous the interest rate like business is, right? So most of us have credit cards, right? And have y'all looked at your rates recently? So as I just said, rates are effectively, rates in March of last year were effectively taken to zero, right? Rates are now up to about 1.5%, generally speaking. Look at your rate on your credit card. The thing is like 25% or more, right? So these companies have no interest in having us earn money on interest, right? So like Brent said, yeah, rates have gone up a little bit, but that bank account is coming from such a low base, 0.05%. They're going to raise it maybe to 0.6, what is it, 0.05 or 0.5?
0.05.
Yeah, so they're going to take it from 0.05%.
Oh, it's not even at 0.5%.
Yeah, not even close.
Yeah.
So they're taking it from 0.05% to maybe 0.07%. Like, really? So these businesses have no interest in us earning money off of interest. And on the flip side, they love to charge us astronomical interest rates because, again, if rates are effectively zero and they've been like that for a year and a half, why in the world are credit card rates still 25%? Credit cards are the biggest ripoffs on the planet. The fact they have not lowered rates at all during this whole pandemic.
Many of them increased it. They've increased their rate, and they're saying they have to do it to protect themselves.
Right. Yep. So to kind of recap all this, this is the main reason why we're seeing a lot of volatility in the market right now is the fact that rates are rising rapidly. Again, not that they're rising, because as we showed earlier, the stock market and rates typically rise together, slowly together. That's normal. It's when we get these huge spikes that the stock market then kind of loses its mind, and then it'll drop off. But as we always say, every dip is a buying opportunity, because since the last 100, 200 years, stock market only goes from the bottom left to the upper right, and every sell-off has been in a buying opportunity. So, take this time to actually look at your watch list, see what you been wanting to buy, or double up positions in. But also, like I said, look at banks, look at brokerage firms, look at insurance companies, because those will do well in this environment. I personally don't have any of those, so I'm actually starting to look at them myself now.
Yeah, so I have some banks, but my portfolio was still smack in. I think I have a pretty big holding in JP Morgan. But, with that being said, just understand this, people. If you go into a banking or any institution that has, some type of saving or what they call their investing tools, and it says, come look at our interest rates, they've increased 35%. Please understand that does not mean that you will receive 35%. That simply means that it may have gone from like 0.7% to 0.9%.
Right.
So it's not what it looks like. Read the fine print, people. And, really, if you're still saving your money in a savings account and you're thinking right now, whoo, I'm so glad my money was in a savings account because I avoided all of this that's happening in the stock market, you couldn't be further away from wrong. The market typically is going to come back stronger unless you believe that the entire U.S. government is about to fail, which you think that the banks are the reason why they wouldn't fail. Corporations are the reason why the U.S. government will not fail. So just understand that.
And also remember inflation, right? Inflation on average is 2 to 3% per year during the pandemic. So, all right, here's an example, right? Today, Dollar Tree. A lot of people love Dollar Tree because you go there, buy things for $1. They today said they are raising prices from $1 to either $1.25 or $1.50. Dollar Tree is raising their prices because why? Because of inflation, right? So they're raising prices 25 to 50% today.
Per
Now,
item.
but again, yeah, per item, yeah. Now remember, that's going from a dollar. You might say, oh, it's going from $1 to $1.25, no big deal. But it is a big deal. That's still a 25 to 50% raise on a product that you before were paying that much less. So this is an example of inflation, right? So inflation is happening all around us right now. During the pandemic, inflation has been running at close to 10%. And we just see Dollar Tree is raising their prices 25 to 50%. So if you have your money sitting in that savings account, you're getting eaten up even more now because inflation is so much higher than the average 2 to 3%.
Yeah, and we can give you millions of examples of the inflation, COVID inflation, and many of these items, milk, eggs, gas,
Bread.
bread, wood.
Sure.
I mean, you're talking about a 2x4 at Home Depot. This may seem simple to some of you all, but understand those who are getting houses built. A 2x4 at Home Depot originally cost at the beginning of the pandemic maybe $375, $320 on the high end. That same 2x4 is around $9 to maybe $11 now. That's huge. And so, again, those of you all who are in savings accounts thinking, well, my money's safe, I can see it, I can touch it, I'm not dealing with the stress of the market. Yeah, you're dealing with a different kind of stress. It's the stress of your money not being your employee. And you're essentially bankrolling your money because the bank is still making money off of you, and your money's at rest while you go out and work. So your money is the one taking a vacation while you're just working, putting more money into a savings account, and you keep putting it on vacation. So really,
and with that money, you're losing buying power every day, right? Inflation is going up pretty much almost every day. If your money's just sitting in an account earning nothing for you, you're losing that buying power every day. Yes, you'll have the same amount in your account that you had 6 months ago, but you won't be able to buy as much. Before you can buy maybe two or three things of eggs, now you can only buy one, right? So the absolute dollar amount's the same, but your buying power is way, way less.
Yeah, and I have an account right now. Today it was down $7,386. So I'm gonna say it again, like $7,386. $7,386. How many people think that's a lot? Like, I would love if you can hit a comment. Put a 1 in there if you think it's a lot. If you're listening to the podcast, just say it in your head. But what that means for my portfolio in this particular account, that between September of last year and September of this year, I've only made $77,000. That's it. That's pregnant pause, right? And so, do I mind being down $7,000 in a day? Not at all, because
especially when you've made almost $80,000 in a year, being down seven. Well, yeah, is it great? No, nobody wants to be down. But when you take a step back, you realize, okay, it's one day, no big deal. I mean, that would have to happen every day for the next, I don't know how many days for you just to break even.
Yeah.
Right. Because you're up so much. So yeah. So the market. I was going to say the market never goes up in a straight line. There's always going to be dips and dives. But as I said, going back 100, 200 years since that market, every dip, every downturn has been a buying opportunity because the market always resolves higher. So this is just another one of those times. I've been doing some buying the last couple of days. I know some members of IA have been doing some buying the last couple of days. So
this happened last September. We actually did a live on it. I think at the time, Tesla in particular, because I remember my account was devastated because I had like a 20-some% stake in Tesla. It went from 720 to like 590. Do you remember that?
Yeah, I remember. Yeah,
it went from 720 to 590 in like 2 days, and everybody was losing their mind. And I increased the position. It hurt, but I was like, you know what, buying opportunity. So again, we go back to this. Make sure the company that you're looking at that you want to buy has strong fundamentals. This interest rate environment is not done with the fluctuations, and really the technology and the speed at which technology is really just moving, and also energy. There's so many variables in our economy right now that are changing, and they're never going to be the same again. You can either be part of it, or you can watch it occur, or you can play that whole fear game where the sky's falling, so I watch everybody else burn and crash because your money's just burning slow.
Slow,
And
yeah,
and you
slow,
can't
and
see it.
and it's even worse because you don't even know how bad it's burning, because you don't see it, right? You don't. I mean, like I said, you look at your account today, it'll look the same as it does in 6 months. But again, your buying power, the amount of stuff you can buy, has dramatically been reduced. But you don't see it. But you'll feel it once you go out there and try to buy the staples, eggs, bread, even a car, a house, clothes. Well, then you really feel it.
Yeah, and that it goes back to even what I'm saying. When I opened that brokerage account and saw negative 7,000, again, emotionally, it's a more immediate response because you feel it. It's in bright red. It's the first thing you see. But when you're in your bank account, nothing lights up in red. They don't show you how much buying power you're losing every day.
Right.
They really should actually. Now thinking about it, but that's a bigger fight. And you, because of that, you get lulled into this place of complacency. And it's similar to, I think the story is, if you put a frog in water and heat it up slowly, it won't jump out. It'll literally just boil. That's what's happening to people who have savings accounts.
Mm-hmm.
And at some point, somebody's going to eat you, and it's the government. And so just understand what's happening with your money, and please see through the smoke screen. Even the information we're bringing to you all today, we are not all of a sudden becoming cheerleaders of treasuries and bonds.
No.
I mean, I would never do it. I can say that. So we just
the whole point of this was to explain why we're seeing the volatility.
Yeah.
We're in no way saying that because rates are rising, you should go put your money in a savings account. We're saying the absolute opposite. We're saying because rates are rising, the stock market is down. Now is the time to buy stocks that are on sale and on a discount. Definitely not into anything that's interest bearing.
Yeah. So everybody, we really thank you today. For our stock picks, you can actually visit us on Facebook. You can go to Investing Education Academy on Facebook. You can see one of our stock picks today. If you want to go into the membership platform, which is IEAmembers.com, you can go there, log in, and you'll be able to see 2 stock picks today. And it might be stock and crypto, or 2 stocks or 2 cryptos. It just depends. You never know what you're going to get. So you can go find out, because again, inversely, today Bitcoin was relatively stable compared to what was happening in the market. And so it was a couple cryptos that followed the path of the market, but then there were some outliers that they actually excelled today. So again, going back to that diversified portfolio, this is why, with the Investing Education IEA Crypto Bulls group, we're really looking at how we're diversifying our money in the crypto space, not only just stock, but then with the IEA Panthers, which is our highest membership group, we're looking at land deals and private equity deals so we can stay diversified. So hopefully you all are staying diversified too. I promise you, again, we're saying this not for today, but for 5 years from today, when hopefully we're still out there, spreading the gospel. Some people who chose to make a decision to get into the market are really enjoying that decision. And, hopefully those of you all who just wanted to watch eventually make the decision to actually get into the market. Oh, I got to say this. Shout out to Leon. This Saturday, Leon is going to be our Ask an Expert. So many of you all, actually, you should share this right now. So a lot of people have been asking us about options and, do we do options? Can we show them how to do options? So this is going to be a 101 tutorial on options trading. This Saturday, 6 p.m. It's for IEA members only, paid IEA members only. And if you want to join, you can go to IEAmembers.com and actually join the community. But Leon will be our expert on Ask an Expert, and he will be talking about options, the basics of options.
And I will say, I'm going to have some really, really interesting information that's going to shock everybody. I'll just leave it at that. It's going to shock everybody. What we're going to discuss and I'm going to reveal on Saturday is going to shock everybody.
Shock the world.
Shock the world. Yep. Shock the world. Yep. Yep.
So again, we hope to see you there. Our membership is 100+ growing. Continue to share with your friends, invite people. We really want to make a difference in this world and get people's money to be an employee versus just something on vacation inside of an account. Everybody, thank you for being with us, and we will see you all next week at 9 p.m. Thank you so much.